It's very common, especially in this environment now, to have percentage rent lease. And the REIT rules recognize that REITs also operate in the real world, and they also need to have percentage rent lease. But while in the non-REIT world, it might be acceptable to do a rental arrangement based on a percentage of net profit, in the REIT world, it's thought of that's too risky for an investor. It needs to be based on gross instead of net income.
Joining me today is Shiukay Hung, partner and co-chair of the National REIT Tax Practice with DLA Piper. Thank you so much for joining us today.
Thanks for having me, Matt.
Now, I understand that equity REITs must earn most of their income from real estate-related income like rents from real property, and that you spoke about that at the Intro to REIT Taxation panel here at REITwise. But what are some of the surprising issues relating to the calculation of rents from real property someone new to REIT should be aware of?
I think what is surprising to especially seasoned real estate operators sometimes is they might have a document, it's a lease, they've used it hundreds of times with hundreds of tenants, and it's their favorite form of lease. It could be a fixed rent lease, it could be a percentage rent lease, it might be short-term, maybe long-term, but point being, they've used it tons of times and have vetted it tons of times with their real property attorney. So when they now are in a REIT kind of asset, they're surprised. They're like, I can't just take my lease that I've used everywhere and use it here. You're telling me that rents from real property is not because it's under a lease. So that is often surprising to them. And even though it's surprising, it does have a little bit of logic to it. The REIT vehicle was thought to be a very passive protective vehicle for retail investors. That was kind of the tax policy behind it. So while in a more traditional real estate kind of environment, you might be willing to do riskier thing with what you consider as rents, the REIT tax rules are more protective. So what are some examples? So for example, it's very common, especially in this environment now, to have percentage rent lease. And the REIT rules recognize that REITs also operate in the real world, and they also need to have percentage rent lease. But while in the non-REIT world, it might be acceptable to do a rental arrangement based on a percentage of net profit, in the REIT world, it's thought of that's too risky for an investor. It needs to be based on gross instead of net income. So concepts like that is a little bit of a translation, but we make it work. We make it work.
And can you explain how REITs use hedges and rules they must follow to ensure that the hedges are respected?
That actually goes a little bit back to your first question. As you pointed out, a REIT needs to predominantly earn rents from real estate, and that's really what they're trying to do. Now, a hedge, as a real estate dirt person, a hedge is a kind of a complicated thing. Like, what is this? Some kind of financial instrument? It's really a derivative. So that doesn't look and feel a lot like rents from real property. It might not surprise you. In fact, it is not rents from real property. So a derivative income is generally thought of as bad income. It's just not the real estate business, right? But even when you're a dirt real estate and equity REIT, you do need to borrow third-party financing. We all need bank loans to run the real estate business. And so the tax rules here recognizes that, sometimes a REIT might need to get a loan to either acquire or carry real estate, and pursuant to that, imagine you have a floating rate loan. You want to enter a hedge to convert this economically to a fixed rate loan. And that kind of hedging is permitted under the REIT tax rule. It doesn't say it's good rents from real property, but it's allowing you to at least ignore it for the purpose of REIT income testing.
And finally, what are the consequences for REITs that inadvertently fail to comply with some of those hedging rules?
The key words here are inadvertent, right? So if you made an honest mistake, you were careless, best if it's your first time. If you keep making the same mistakes over and over again, not a great fact pattern for you. And then you try to address it, right? You try to, just like in life when you did something wrong, you tell someone you're sorry, you should really mean it. You should have ways to address how to not have it happen again. It's the same concept here. If you missed your hedge, you should take a serious look at your operations. How can you have operational guidelines to make sure this doesn't happen again? Do you consider having a global hedging policy so everyone knows that this is your intention to always timely identify the hedge on the day of the closing of your hedge? This is why it's hard for some REITs, because on the day of closing of your real estate loan, right, a lot of things are happening. You're negotiating a loan, trying to get that all finalized. You're finalizing your hedge document. And then the last piece of document you need is to timely and properly on that day identify your hedge. And you can imagine sometimes that get lost. So try to do that. If you miss it once, don't do it again. Try your best.